Welcome to the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining us. As I always say, subscribe to this channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage, and also entertain. And welcome to the 100th episode, my friends. We're going to be dropping some gems for you today. We're bringing back our top 5 most downloaded, our top 5 most viewed, our top 5 most requested episodes on this single episode, and I hope you enjoy it. We got some Josh Brown. We got some Tyrone Ross Jr. We got some Bethany Mclean. Guys, sit back, enjoy it, and you know what I always say? Let's get it. So in this first one, we were talking to Josh Brown, CEO of Ritholtz Wealth Management. I got to give it up for my guy. Great time at Future Proof, my friend. Great job out there. We were talking about the RIA industry, how small RIAs are finding growth opportunities and what small RIAs can be doing to better integrate themselves into this space and take advantage of what may be to come. And talking about, well, how the industry is shifting. Take a look.
What is up, man? What is going on?
So great to be with you.
Hey, well, before we get started, we're going to have a little fun. You're a Yankee fan, right? Is that what I'm hearing?
Yes.
Well, of course, you know, I was a Yankee, and I don't know. I will tell you this. The Yankees are the top class in regards to other organizations, because I've been with multiple organizations in the MLB, and I'll tell you, man, the Yankees, the way they do it versus the Oakland A's, quote unquote, it's night and day, man. I thought MLB was MLB wherever you went, but now, no. The Yankees are class.
Oakland lost its team to Vegas. You know, it's sort of there's a Yankee way for sure. You played in the old stadium too, right?
Old stadium, yeah. Every time we walk down underneath the stadium, we literally see exposed cords everywhere. I'm like, what's going on? It was old school.
But you know what's so funny about that is the fans are nostalgic for the new stadium is beautiful. Like nobody would say they didn't do a great job, but like the fans are always nostalgic for. Like I'm nostalgic for Shea Stadium too. So I grew up. My dad was a Mets fan, so I grew up going to Shea. Citi Field is awesome, but like it's just something. There's something magical about the thing that you can't do anymore.
I just remember going on the 4 train to the Bronx, getting in the turnstiles, like, you know, got my little Metro card. I miss that stuff, man. You know what I miss about New York the most is is waking up and I can go get me a breakfast sandwich any day, but any time of the day. Like I want to get me a breakfast sandwich, give me a chocolate milk and a breakfast sandwich, go work out.
Yeah.
I miss that, man. Those delis, great.
Oh, the bodegas, like the chopped cheese.
Oh my gosh.
In the Bronx.
Oh yeah. It was
you ever
awesome.
see like Jesus and Mero talk about that stuff? they turned that into a show, basically.
I'm telling you, it's great, man. Go in there, get you hey, what do you want? Ham and cheese, ham, egg, and cheese on a bagel, man. Boom. All day long.
The guy behind the counter is wearing a Yankee fitted and some Timberlands.
Yeah.
In August.
Welcome to New York. Hey, long story. I don't want to get into the New York stuff, but I'm in the subway. And I'm like, what the hell is this? It was a rat. I thought it was a cat. There was a cat. The rats are signs of cat. Man, but that's not what we're here to talk about today. We want to have some fun. I know we want to have some fun, but we're talking about the RIA industry. Man, you and I have both seen it over the last decade or so, the consolidation in the business. I mean, especially with lower interest rates. The RIA industry has been experiencing a significant uptick in mergers and acquisition over the past decade. Lower interest rates have facilitated some of the easy access to capital, agent advisor demographics, succession planning, and of course, in my case, rising operational costs have incentivized the consolidation to get economies of scale. So I guess my question for you is, what is your perspective on RIA consolidation and its impact in the overall landscape?
So my perspective is that you're absolutely right about how important this trend is for all of our careers and prosperity and strategic planning. And when I first reached out to you, I saw you passionately like talking about this topic in a way that most people are afraid to do.
Yeah.
Not that you were saying anything so controversial, but you were spitting. I don't even know how else to put it. You were just going. But I said, like, this guy is as passionate about the industry as I've always thought of myself as being. So I got to talk to this guy.
Yeah.
So I agree with your premise that if we're not careful, and I don't really, we can talk about solutions in a minute, but if we're not careful, we could end up recreating the wirehouses.
Yeah.
And we could be in a time warp going back to 1986, where everyone's dealing with Merrill Lynch and Smith Barney and Lehman Brothers and Bear Stearns, and if you don't like it, too bad. I don't think that's going to happen, but without a doubt, there are some very large RIAs that effectively are using borrowed money and a cap table filled with PE firms, and they're recreating wirehouses. And it's okay. It doesn't bother me. I just hope the whole industry doesn't turn into that.
Yeah, and the whole industry, again, the industry I came from was, you had your large players in the industry, the Fidelities, the Schwabs, the TD Ameritrades, the broker-dealers out there. And the reason why I left that industry is because I was tired of them telling me what I could and could not do. For example, imagine me being in that space and having this conversation. It just wouldn't happen, right?
Yeah.
It wouldn't happen because it's like layers of compliance. Hey, well, what did Josh say here? Well, I don't know. We got to change that word here. What did Kevin, what'd you say here? So you couldn't have these simple conversations because the layers of compliance to CYA, not you, but just the business. So that's one thing. But my next question is going to be about, if this trend continues, should advisors like myself or other advisors in the industry, should we worry about our autonomy? Should we be concerned about, well, I know this is happening. Maybe I need to join another firm. Is my autonomy in jeopardy?
So this is where you and I are going to disagree.
Okay.
Because I have to correct something that I've heard you now say many times, not just now, but okay. You keep referring to yourself as a small advisor. I don't know. I know a little bit more about this than you do.
Okay.
Just because I've been around for longer. Dude, you are not destined to be a small advisor. What you're doing right now on the microphone and on camera every day, you are building trust with an audience. That audience, you might not understand this now. You might not know this now, or maybe you do. I don't know. We haven't talked about it offline. That audience over the next 5 to 10 years is going to be comprised of people who are on a regular basis getting hit with life events that right now they can't even imagine. Father dies, mother dies, inheritances, selling my business, getting acquired, buying a business. My wife just got pregnant. My husband just had a stroke, right? Getting divorced, getting remarried. Oh my God, we just had our first kid. We're about to have a second.
Yeah.
These catalysts are outside of your control, Kevin. Yeah. But what is inside of your control is the fact that when these things happen to the audience that you are building trust with, the first thing they're going to say is, I gotta reach out and get some help. I'm going to call Kevin.
Absolutely.
There's no chance that you're going to do what you're doing at the level you're doing it for the next 5 years and be a small advisor. It just is no possible way. And not only is your audience going to reach out to you for help, but financial advisors like myself from all over the country are starting to pay attention to you too. And the next thing that's going to happen, even before the first thing I said, is they're going to say, hey man, I listen to you. I agree with like almost everything that you're saying. I want to join forces. I have X amount of clients. I'm worried about a lot of the stuff you're worried about. Let's team up. Let's do something together. And then you're going to have to figure out really quickly how to go from being a solo entrepreneur to how to become a founder slash manager and slash motivator of people. And you'll still have time to do the show. Yeah. But like you're going to see how quickly that happens. And I am speaking from experience because my brother, it happened to me. I have no MBA. I have no formal training as a business leader. Nobody that knew me growing up would ever say, yeah, that guy's going to be a CEO, but I'm going on 10 years. So listen to me. I'm not arguing with you for the sake of controversy. I really want you to understand you are not a small advisor today. And I promise you, if you keep doing what you're doing, there's no way that's the category you're going to fit into in a few years.
Next, we have David Kinder. We were having some backyard brawls on LinkedIn, talking about fiduciary versus suitability versus Reg BI and the industry and its in the I guess the ambiguity between everything. We wanted to kind of just hash it out on LinkedIn, and David and I are really good friends now, I suppose. And again, I wanted to have this conversation because it needs to be had. What is a fiduciary? Why it's important? Why is the insurance industry blocking Reg BI and the suitability standard? We discussed that during this podcast. Take a look. So what we're talking about today, guys, is regulation best interest and the insurance community, right? The insurance lobby, which recently basically just did another thing where they just balked at the regulation-based interest. And for all of you who don't understand what regulation-based interest is, the key components of Reg BI, and I'll just start here. This is just my understanding, and you can correct me if I'm wrong. It's a disclosure obligation. There's a care obligation, a conflict of interest obligation, and a compliance obligation. Now, those are 4 obligations there. I understand, and we're gonna get into the context of why the insurance lobby may be opposing this. But am I correct right now about what the key components of Reg BI actually are?
Yes, and yet there's a number of components within that.
Okay.
And that's the interesting part. And so let's start with the insurance company perspective.
Okay.
The company does not want to be a fiduciary institution.
Okay.
The company wants to remain a product manufacturer.
Gotcha.
And frankly, that's what I want them to do. Make the best product. Make the best things. And of course, each insurance company has their own menu of products and services and whatever else that they do. And their job is to cater to the insurance agents, to get the agents to like them well enough that they actually want to sell their stuff. That's why I say the insurance agent is the market. Mm-hmm. The ultimate beneficiary of this work is the consumer, but the agent has to be sold first on the company. The company has to have an attractive line of products with decent compensation. It doesn't have to be the highest, but it needs to be in line with what everybody else is doing. Mm-hmm. And let the company just do its thing. But the higher the overhead gets for that company, what's going to happen? Something has to give.
Yeah.
And it's going to give in the product design.
Yeah.
Because you can't lower the compensation that much because then the agents won't sell it. So it ends up being that the consumer could end up losing. So instead of getting the higher returns that are possible, they're going to price things a little differently. Or instead of having a certain kind of income rider on a policy, they're going to lower it just a little bit. Whatever it is, there's going to be a give and take. And I want the companies to give us the maximum benefits for the consumer while rewarding the agent and the company being having a profitable business too. All 3 have to fit. If they don't all fit, something's going to give. And when something gives, the company usually loses.
So I'm glad you said that because a couple of things stuck out to me. So just for clarity for everyone, David and I have had some spirited conversations on LinkedIn. Now, spirited as in like, hey, back and forth. I'm right, you're right, I'm wrong, those types of conversations. But this conversation today is based on us just trying to gain an understanding on what this actually is and why we may have a difference of opinion. So you mentioned the fact that, and this is just one thing that stands out to me about Reg BI, that agents may not be incentivized to sell a certain product because they're not being paid as much. And that's just economics, right? We understand how the economics works. But
Right, exactly.
the same thing could be said on the fee side, where everybody, in regards to just the reduction of cost, and for the investment business, right? It was a race to the bottom. ETFs, mutual funds have to lower their fees, lower all the other stuff. So what makes insurance any different than the investment side? That's my question.
Here's the difference. And the difference is
Outside of
the
suitability and
investment side.
fiduciary and all that stuff. But go ahead.
No. We're actually, it's directly related to the legal definition of fiduciary.
Yeah.
And putting everything, best interest sounds so good.
Yeah.
And quite frankly, we can all agree. I don't care what mode of business you're in. You could be selling cars. I don't care. We should all have the best interest in mind for the client.
Yes.
And I don't care what mode of business. I don't care what mode of compensation. The thing about fiduciary is that it takes best interest to a different level, but it's a regulatory legal level. It requires certain disclosures, and especially, and here's the disclosure. It's the scope of the engagement.
100%.
Where anything that comes out, any compensation outside of the client relationship, if the client is not paying you directly, it must be disclosed.
Yes.
Now, with fee-based business, here's the thing. It sounds so easy, right? You give me $500,000 to manage, or $1 million, whatever it is. And the advisor typically will say, my fees are 1%.
1% of assets under
and that's
management,
automatically
yes.
a lie. And it's automatically a lie only because there's usually additional fees within that. You have your custodial fee, you've got your third-party asset management fee, and you might have another fee on top of that. I was with an RIA. The fees could add up to about 3%.
Okay. Wait. I'm not gonna let you get away with that. Now, this is where we're gonna have a conversation.
No, bring it on, dude.
I will say, in some instances, you're absolutely right, because there are some RIAs out there that may be charging 1.5, and then of course the underlying management fees inside of the expense ratios, maybe 0.75 or even 1%, depending on that. And then of course you'll have your additional custody or broker dealer costs inside of that as well. Now, yes, I can see that, but that's on the extreme side. That's extreme. It's extreme.
Fair. Now, granted, but usually the way that advisors will casually talk about it is, my fee is 1%. And what they're meaning is that their cut out of whatever it is 1%.
Tyrone is a beacon in the crypto space. He knows crypto. He's been in this crypto space probably since it began. So I really enjoy his knowledge around the space, because I learn a lot when I speak to him, and I rely on that. CNBC guy, he's been on all these different networks talking about these different things. So without further ado, Tyrone Ross Jr., crypto, what's expected, what's happening. This is as Bitcoin was rising and went over 69,000, which was the resistance level there. And now it's back down to 62 and some change. But this was a good conversation. Take a look. I have my man Tyrone Ross Jr. on the call today, CEO, co-founder of Turnkey Labs, and CEO of 401 Financial. Hey, before we get started, where's my money tree? Is my money tree back in the background right there, man?
Which way is it? I gotta go the other way. It is.
There's a money tree. Hey, Tyrone, what's going on, my friend?
A whole lot, man. Exciting to chat. There's a lot going on in my world, the crypto world, all the worlds that we play in. But before we get started, I know we were talking about this prior, man. I'm proud of you, happy for you that you are leaning into your purpose, and that is getting noticed. You are killing the LinkedIn game, and being at this a long time, and I know you know as well. We need more people like you in our space. So, I'm watching, I'm following, I'm cheering, and it's just awesome to see, man. So keep going.
Man, you make a tear come down my face. I need that right now, man. It's not about me, it's about you today. But thank you so much for the love, and appreciate it. And I appreciate all the followers. I'm going to tell you this about you real quick, because you may be the fastest guest we've ever had in regards to foot speed.
Yes.
But you're not the fastest person that's ever been on this podcast. And read between those lines, my friend. Read between those lines.
Okay. No,
man. But hey, thank you for joining us today. And I just have some questions, because I know we're talking about crypto. I know you probably get tired of hearing about it. I mean,
Right.
a couple of weeks ago, I was on LinkedIn and you said, guys, I know Bitcoin has been rallying. This is great to see, but don't you even think about, seeing a significant push higher with institutions until we get to that resistance level of 69,000.
Yeah.
And I'm going to say this, talk about prescient, talk about like, wow, this guy knows what he's doing, man. So tell me about what made you even see something like that far out in the future? And then kind of tell me about your ideas around that.
Yeah, and thank you for that. And I always tell people it's not too many marbles up here, but the ones I got work very well. And so it was a couple of things. One, being in the space for almost 11 years now, right? I've gone through a bunch of these, and the old high was just a level where, again, there was just going to be a lot of resistance, and it wasn't going to be until we got through that anyone outside the space, especially in institutions and financial media, weren't really going to care, right? Yeah. And studies have shown even in traditional markets, right? You break new highs, you're probably more than likely to hit higher highs. And with crypto, with the way the momentum is, and the velocity and the ETFs being approved and everything else, it just made sense that was as they call a psychological level for people. If where you got through that, it was like, oh, okay, right? It was on. And it turns out that at least this time I was right there.
You were right, man. And I remember your company Turnkey, you were talking about this a few years back when we were on Q&A together on NASDAQ and ultimately when we first met. You're trying to get advisors like myself more in line with what our clients are doing and into their wallets so we can see exactly what's going on with their crypto holdings. Yeah. So talk to me a little bit about how that's coming a little bit and then are we getting closer to the adoption where advisors have access to those wallets where we can connect them to our financial planning engines?
Yeah. So we have an integration now, which is live and being used by customers by all accounts through Morningstar. So any advisor watching this that uses by all accounts will be able to get access to that data. It's rolling out slowly. I think they pushed it out to 2 customers so far. So that's a huge win for me because this is a personal problem I've had going back to 2016. So it was something that, for me, a sense of pride because there were a few attempts before and we actually got it done with the $13 billion company, right? Public companies. It's pretty cool when an idea in your head goes to that. So 2 examples of real life of why that matters. I spoke to an advisor yesterday who found out that his client has a $12 million account at Coinbase.
Wow.
Yeah.
Okay.
This is exactly what I'm talking about. But he can't see it. The client is like this on the phone. See it's like this, right? So that's not, as advisors, we can't do business like that. But if that advisor had Turnkey, the client could just off in, bring that data back. Now it's in the advisor's platform. He can see the positions, right? He can see the cost basis. He can see all of that. He's just operating off of what the client is telling him. So that's a real life example of the opportunity for advisors to, one, grow relationships. Obviously, turns out that position is just almost half the client's net worth.
Yeah.
Right. And also, it's an opportunity for advisors to have deeper client conversations around crypto without really having to know crypto. That's what we wanted to do. Strip away the crypto leads and just make it easy to go, oh, this is a taxable event, or, oh, you 12 million, there's probably some estate planning you need to talk about here. So just things like that.
In this episode with Matthew K. Lewis, we discussed Filthy Rich Politicians, his book, and how legislative members are using legislation to be able to insider trade and how they become wealthier as they progress in their political careers. Take a listen. Matthew K. Lewis here author of Filthy Rich Politicians. Matthew, thank you for joining us today, my friend.
Hey, man, it's great to be here. Good to talk with you.
Man, I appreciate it. So, again, I've learned so much in the last, I guess, couple of months. I read your book, Filthy Rich Politicians. Do you know what was really refreshing about the book is that in the first couple of chapters, you come out right away and you say, this is what I am. I'm a center right leaning individual. I'm not pulling any punches, because you didn't hold anything back. You were punching the right, punching the left, punching the middle. You were getting them all. So I appreciate the fact that you did that, because you left no ambiguity. So thank you so much for just getting that out in the front, because a lot of people will just write a book and then you can kind of say, are they talking about this side over here? Are they? And this leaves you with all this ambiguity. So thank you so much for that, my friend.
Sure thing. No, I completely agree. I don't want to be reading a book and having to guess, like, why did he say this? Exactly. Does he have a hidden agenda or ulterior motives? And so I tried to put the cards on the table. And actually, I thought maybe it would even reinforce the book when I said, like, look, I don't hate rich people.
Yeah.
My wife is a Republican fundraiser. I'm not out to, like, show up with, like, pitchforks and lanterns and take down rich people. But I do love America, and I believe in, liberal democracy. And if we want to preserve the system that we have and keep the barbarians from storming the gates, then we have to have a system where where it's not rigged, Yeah. So when Donald Trump shows up, and I'm not a huge Trump fan, but when Donald Trump shows up and starts saying the game is rigged, well, look, there's a reason why people believed him. Yeah. It's because it kind of is, at least certain parts of it certainly look rigged.
Hey, that makes me smart. I didn't pay taxes. It makes me smart, right?
Yes.
And that's when, like, I know Dave Chappelle said it on the Saturday Night Live skit, but he was like, the reason he won is because I know the game is rigged because I'm using this game, right? Yeah. And he's absolutely right. And I guess it goes back to the point of, like, the financial divide between politicians, civilians, and the erosion of trust in our industry. Like, can you talk a little bit about, well, first and foremost, like, why should we trust these individuals that supposedly have our best interest in DC, when we know that, there's these lobbyists out there that are possibly giving them money to sway them one way or the other, or there's big PACs out there that want them to vote a certain way?
Actually, this brings up a point I should have made earlier when you asked me, like, why I decided to write the book.
Yeah.
Once I had this idea pitched to me, I had seen this Facebook meme that said the average American, how is it that the average member of Congress is a millionaire when the average American makes, this is what it was. Only 1% of Americans are millionaires, but the average member of Congress is. So that got me thinking too. Yeah. So I started looking into it. It wasn't quite accurate. The Facebook didn't have it exactly right. Something like 5 to 7% of Americans nowadays are millionaires. It ain't what it used to be, but it is true. More than 50% of members of Congress are millionaires, and so the discrepancy is pretty big. And if you're a regular American out there trying to make ends meet, it seems a little weird that, all these congressmen are really living large. And I think that there's a perception, that they're feathering their own nests and that the game is rigged. And I think that basically erodes trust in elected officials. But as you were just noting, it's more than just that, right? It's not just that they start off richer than normal people, which is, problematic in its own right. It's the sense that they're getting richer while in office, right? And even when they leave office, they've got that revolving door where they leave office and then they become a lobbyist and they can still cash in. And so I think, it's from cradle to grave in their case.
Lastly, this is Bethany Mclean, The Big Fail. This one just came out, got a lot of views on YouTube. And this is something that I think is very, very poignant, because we talked about COVID-19 and we talked about how the healthcare industry and the for-profit motive kind of destroyed people's lives. You had the community hospitals and you had the for-profit hospitals not taking patients from those community hospitals because it wasn't in the best interest of the for-profit hospital, because it wasn't profitable and people ended up passing away. So we talked about how profits were over people and how COVID-19 exposed our healthcare industry. You got to take a listen to this episode. One thing that you mentioned to me, or mentioned in the book, was the healthcare industry and the system of inequality. I mean, like I've always said, it's always the Black and brown communities, whether it be the community hospitals, whether it be the more well-off hospitals. Talk to me a little bit about around just the divide between the well-sourced hospitals versus the community hospitals that weren't as resourced, and why is that? I mean, why is there such a huge difference between the two?
Right. Well, that is one of the horrible things about the pandemic, is that we saw that it disproportionately affected people who had not had access to healthcare before the pandemic. It preyed on all of our pre-existing weaknesses, both as a society and in terms of people's health. But the underlying reason for why we have such an unequal healthcare system is that we treat healthcare like a business. But yet the system incentives that are in place is not the way. If you were to treat it as a business, then you would want to have a system that incentivized better care at a lower cost. But we don't. We treat it as a business, but we have this incredibly gameable set of rules in place that enable hospitals to make money by basically gaming the system and figuring out ways to maximize reimbursement, not by delivering better healthcare at a lower cost. And our system rewards the hospitals that play the game really well, and it disproportionately punishes those that don't play the game. And the ones that don't play the game are, of course, hospitals in less well-off areas. And then people say, oh, this hospital isn't making money, it needs to close because it isn't making money. Well, wait, you established the preconditions by which the hospital could make money, and you made it impossible for this hospital to make money. And now you're justifying closing it and removing beds from an area where they might be needed because you established the preconditions that made it this way. And so one of the numbers that really stood out to me, and I might mangle this a little bit because it was a while ago, but when the pandemic hit, the less wealthy areas of New York, like Queens, had like 1 bed or 1.5 beds per 1,000 residents, whereas wealthy Manhattan had 6 beds per 1,000 residents, precisely because of this system of incentives we've put in place. That's not looking at hospitals like a part of our healthcare as national infrastructure and saying, where do we need beds in order to take care of people? That's a direct result of treating it like a business, but with these really flawed incentives in place. And then lo and behold, a pandemic comes and you don't have beds in the places where you need them. And so one of the things that really stood out to me when we were working on this book was that all of the stories of hospitals just with patients being with morgues outside and terrible overwhelmed hospitals, they were all in poorer areas. And that's directly because of this under-resourcing of these hospitals. And then to compound that, there are no incentives in place that reward the system coming together as a system in a time of crisis and saying, okay, if this hospital here is being overwhelmed with patients, they should be transferred to this wealthy hospital here that has the money to take care of them. There was none of that. And so the only hospitals that did it, like Rush in Chicago, did it on their own because they thought it was the right thing to do. And so that's so we have this twofold problem. We don't have a hospital system. We have this complete chaotic mess that can't come together when there's a problem. And then we have a system that treats hospitals like a business, but without the incentives in place that even then, arguably, I'm not sure healthcare should be a business where the bottom line is the only thing that matters. But at least if you're going to treat it that way, have it be the incentive to provide better care at a lower cost. And that's not what our system rewards.
Well, you got Milton Friedman, right? This is Uncle Milton Friedman, or you want Adam Smith? Which one do you want? A lot of us say, freehand capitalism, Adam Smith, or do we want the Milton Friedman where we're saying shareholder wealth is the most important thing and the only thing that matters? And what you're left with is what you just discussed.
Yes. Yes, but when it comes to hospitals, it is, I think, important to point out that it is particularly perverted. And one of the numbers that stood out to me, so HCA Health is the best performing hospital chain in the country. Out of the top 10 most expensive hospitals, 7 of them are HCA hospitals because they figured out how to play the game. They're not so profitable because they're delivering better care at a lower cost. They're profitable because they figured out how to game the system, and that's then a really perverted form of capitalism. I mean, even if you think that Milton Friedman's precepts should apply in healthcare, then make sure that the profits you're incentivizing are the profits you want and not profits that come from gaming the system.
Thank you guys for joining this 100th episode of the 980s podcast. Subscribe to the channel. Don't make sure you get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And today we're here to entertain on this 100th episode. I hope you guys enjoyed it. I hope you guys continue to subscribe. If you have anything you want us to discuss, please let us know. If you have anybody that you want on the show, please let us know. We are growing, we are fierce, and we're ready to play. Stay humble, stay safe, my friends. I'll see you again soon.